Welcome to the chapter on corporate finance. In this chapter, we will explore capital structure, dividend policy, and corporate governance. These are key areas in corporate finance that help in making informed financial decisions. Capital structure refers to the way a corporation finances its assets through a combination of debt, equity, or hybrid securities. The decision on capital structure is crucial because it can influence the value of the firm and the cost of capital. Debt financing involves borrowing funds through loans or issuing bonds. Debt holders are entitled to interest payments and have a higher claim on assets in the event of liquidation. On the other hand, equity financing involves raising funds by issuing shares of stock. Equity holders or shareholders own a portion of the company and are entitled to dividends and voting rights. The optimal capital structure is the mix of debt and equity that minimizes the company's cost of capital and maximizes its value. The cost of capital is the rate of return required by investors to compensate them for the risk of investing in the company. The weighted average cost of capital, or WACC, is calculated using the formula WACC-CC equals the market value of equity divided by the total market value of the firm's financing, multiplied by the cost of equity plus the market value of debt, divided by the total market value, multiplied by the cost of debt, and then multiplied by 1 minus the corporate tax rate. Suppose a company has a market value of equity of $500,000, a market value of debt of $300,000, a cost of equity of 10%, a cost of debt of 5%, and a corporate tax rate of 30%. The WACC would be calculated as follows. WACC equals 500,000 divided by 800,000 multiplied by 0.10 plus 300,000 divided by 800,000 multiplied by 0.05 and then multiplied by 1 minus 0.30. This results in a WACC-C of approximately 7.56%. Dividend policy refers to the strategy a company uses to decide how much it will pay out to shareholders in dividends. The main types of dividend policies are stable dividend policy, constant dividend policy, and residual dividend policy. Several factors influence dividend policy, including earnings stability, growth opportunities, tax considerations, and market signaling. Companies with stable earnings are more likely to pay regular dividends, while those with high growth opportunities might prefer to reinvest earnings rather than pay dividends. Tax policies can also influence whether companies prefer to pay dividends or repurchase shares. Additionally, dividends can signal a company's financial health to investors. Consider a company with earnings per share of $5 and a payout ratio of 40%. The dividend per share would be calculated as follows. DPS equals EPS multiplied by the payout ratio. This results in a dividend per share of $2. Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. It involves balancing the interests of a company's many stakeholders, such as shareholders, management, customers, suppliers, financiers, government, and the community. Key elements of corporate governance include the board of directors, shareholder rights, transparency and disclosure, and ethical conduct. The board is responsible for overseeing the management of the company and ensuring that the company acts in the best interests of shareholders. Shareholders should have the right to vote on important issues and have a say in the company's decisions. Companies should provide accurate and timely information about their financial performance and governance practices. Additionally, companies should adhere to ethical standards and practices in their operations. A company with strong corporate governance might have an independent board of directors with a majority of non-executive members, regular and transparent communication with shareholders, and a code of ethics that guides the behavior of employees and management. In summary, understanding capital structure, dividend policy, and corporate governance is essential for making informed financial decisions that maximize shareholder value and ensure the long-term success of a corporation. Thank you for watching this chapter on corporate finance. We hope you found the information valuable and insightful.